Hi everyone, it's John Mitchell and we're continuing on with our videos on the types of businesses. Today we're going to look at companies, and the process of beginning a company structure is what we know as incorporation, and it's where the owners purchase shares in the business and now they become shareholders. So a company is a separate legal entity to the owners. So what we spoke about in the previous video where we looked at the sole trader and the partnerships, we said that the owners and the business have the same legal entity, but now with a company it changes dramatically. The company now has a separate legal entity to the owners, so it's almost like creating another person. And as a result of that, the owners have limited liability. Now what that means is that the most a shareholder can lose is the amount they have paid for their shares. So if they decide to invest $5,000 into a particular company, the most they can lose is that investment of the $5,000. Now, two types of companies that exist are the private limited company and also the public listed company. We're going to go through each of those, but before we do, just want to cover limited liability before we move on. So using the exact same example we used before in the previous video, we've got our tradie here. They've got their business account, so all the activities to do with their business goes through that account, so the revenue and expenses that they have, but also on the other side, they have their personal assets, which, they may own a house, they may own a car, and it's happy days, they've got $25,000 in the bank. Now, in order to become a shareholder, they may take $10,000 of that $25,000 and invest it into that company. Now they become a shareholder, but the most that they can lose is that $10,000. So if for whatever reason the company is really poorly run, even if they're running the company, it's really poorly run and it goes into debt, or even it can't even operate anymore, so it's going bankrupt, what happens is that they may lose that $10,000 investment. However, their personal assets are protected. So their house, their car, and the rest of the money in their bank is protected, which is very different to the previous video where they had unlimited liability. So a private limited company is a company where a business that is owned by private shareholders that are not available to the public. So sometimes you might see, on the news talking about the share market, shares have gone up, shares have gone down. That's got nothing to do with a private limited company. These are privately owned by up to 50 shareholders, so they can't be publicly exchanged or exchanged very rapidly. So what you see here is a private limited company also has limited liability, and also you'll see proprietary limited or PTY at the end of their name. And so one of Australia's largest private companies is VCE PTY Ltd. So the advantages of a private limited company is that, first of all, it has limited liability and there is a separate legal entity. So the owners are protected, their personal assets are protected. So if the company is sued, it's the company that's sued, not the owners necessarily. And also they pay company tax rate, which is often lower than income tax rate. The life of the company can live longer than the directors. So if the directors pass away or move on, the company, because it is a separate legal entity, can continue. And also it can be often easier to attract more capital with a private company. The disadvantages, now it becomes more complex and expensive to establish. So there's a lot more paperwork and things that need to be done, and it's much more expensive in order to set up a company structure. There's more reporting requirements to the government, and also the shares cannot be traded freely. So if a shareholder in a private company wants to sell their shares, they need to get approval from all the other shareholders before they can do so. So it's not like where they're just put on the stock market and traded. That's not a private limited company. What that is a publicly listed company. So public listed company is one where the shares of the business can be purchased or sold in an open market, such as the Australian Securities Exchange. So when you see on the news here and they're talking about the share price going up or down, this is what we're talking about with a public listed company. Now again, public companies have limited liability, and what you will see is that when a business decides to, first of all, go onto the ASX or some kind of exchange, it's what we call an initial public offering or an IPO, where it's the first time they're offering shares to the public. The shares can then be purchased by the public and freely traded on an exchange such as the ASX, and also you'll see limited or LTD at the end of the company name. So for example, BHP Limited is one of Australia's largest companies, public listed companies. Now the advantage, again, limited liability, much easier to raise capital, so the company can go to the market and say, right, we're issuing more shares. Hopefully the public will purchase those shares. In order to do that, they obviously purchase them with money. The company gets that money and they can invest it in any way they see fit. And the life of the company can live longer than the directors again, and also they pay the company tax rate. So the disadvantages, now it becomes very complex and time consuming to establish, and there are a lot more costs to establish this with a public listed company, even more than a private company. There's more accountability and compliance. Anything Because the share price can change rapidly, anything that a business does that can impact the share price of their company, they need to notify the market of it immediately. And if they don't do that, there can be fines and other consequences. And also, there can be possible loss of control. So, if the share price is really low and the owners don't have control over the share price because it's exchanged on an open market, what can happen is that a larger company or another company can come along and offer shareholders a reasonable price. They may take that up and they can own a large portion of the business, and eventually they can actually take over the control of that business if they hold the controlling interest. So we're going to continue on with our videos in the next video on the types of businesses. But for now, for questions, activities, and to find out more about our Unit 3 and Unit 4 preparation lectures, then come on over to teachingbubble.com.